It's a crisis alert. I'm your host, Steve Van Meter, and thanks for joining me today. In our show today, banks just crossed the line. As you're about to see, they're putting millions of customers at risk. I'm going to show you what the banks are doing and why they're jeopardizing the finances of millions of American households. Now let's turn over to Bloomberg, where he picked today's story up with a headline as U.S. consumer borrowing jumps on a surge in credit card balances. And just when we thought that consumers were at the red line, when we were at the limit of what they can borrow, we find out the banks are extending even more credit into an economic slowdown. But that's not the real story of what the banks are doing. As you're about to see, they're going to break the financial back of millions of their customers. Total credit outstanding rose $19.2 billion after a revised $3.2 billion September increase. Now, you might remember back in September, we thought this was it, that finally consumers were tapped out, that they reached the limit on their credit cards, and all of a sudden we find out that no, they've got more room and they're charging and charging big. Revolving debt outstanding, which includes credit cards, surged $15.7 billion. October included Amazon Prime Day as well as similar promotions at Walmart and Target. And what we saw is consumers come out and spend big. And this is important to understand because they're buying things they don't need with money they don't have. And that's putting them in a position to have to pay this back at a time we already know the economy is slowing down. We know things for workers are not going as well. We're seeing slower wage growth. We're seeing fewer hours worked. And this is a dangerous scenario. But yet the banks are going to put the screws to their customers in a big way. And here we can see what was the third biggest monthly jump on record as consumers whipped out their credit cards and spent. And non-revolving credit such as loans for vehicle purchases and school tuition increased $3.5 billion. The pace of auto sales during the month was the strongest in more than 3 years. Notably, that isn't such a big deal because what we're seeing in the automobile space is demand continued to shrink. Again, boomers, they hit into retirement. At one point, they had about 2.5 cars. Many boomers had 3. Now they're finding out that perhaps 1 is all they need. And with people working from home or on hybrid schedules, they're not commuting as much, not putting as many miles on their car. So demand for vehicles here is plunging in a big way. And while the Fed has lowered its benchmark rate by 0.75 percentage points since September, and here's the key thing, it will take time to filter into cheaper financing costs for consumers. And yet what we've been hearing is all the consumers need is a rate cut. Wall Street's been very vocal about this, that rate cuts are instantaneous, and yet rate hikes take years perhaps to filter through the economy. But the moment the Fed cuts rates, well, that means everybody's a winner. But now the news is starting to tell you what we already know is that rate cuts do not immediately, in many cases, do not pass on to consumers at all. But here's what I want to know. Were you out spending big for Black Friday or during the holiday season? Make a note in the comments, because if you're spending a lot on your credit card, we want to know if you're charging and you know you can pay it back, or if you're charging in the hopes you can pay it back. But what's truly remarkable about the latest consumer credit data is what the Federal Reserve's own website said, that the average APR on credit cards across the U.S. What we found out is just after the Fed's jumbo rate cut, the first cut in many years, we made a prediction. This was from Zero Hedge, that while rates on deposits and savings accounts immediately dropped, and they did, interest rates on debt, such as credit card APRs, will barely budge, if not keep rising. And that is the problem here, is that we're seeing banks cut the rate they're paying on savings. They did that virtually immediately, but what about credit cards? Well, they didn't cut rates. So what we're seeing here is a huge surge in revolving credit, consumers going out and snapping up deals. The question is why, at a time when the economy is slowing down, when the labor market is getting worse, the banks aren't giving them any payment relief. What that means is consumers are going to need more money. And well, we've got the path for you. Let's check out this trade going back to October 31st. Remember, we have this 30-day free trial if you want to start trading. But here's the thing, that 30-day free trial is going away very soon. If you've been thinking about signing up, now's the chance. We put this pair trade on. It triggered on our CTA Time Pro and both our Momentum Time Pro reports for agricultural commodities commodities. That trade up as of Friday's close 6.65%. And here's the notes that we gave our subscribers because we review all the trades and we told them, look, I like this setup, buy it. It's going to go well, and it did. In fact, we told our subscribers to buy right here, and they've taken off ever since then. And let's take a look at our win rate because we've got an 80% win rate on our machine trading that's called CTA Timer Pro. What's critical about this, why we traded against the machines, is because they move massive amounts of money, but they follow the trend. And when the trend's moving and they're behind the curve, well, that signals our entry point, and we've give that to our subscribers with a huge success rate. But maybe you like to trade momentum, but you find it very difficult to trade those technical indicators. Well, we do that with Momentum Timer Pro because we have a proprietary overlay. Here's the best part. You can get the 30-day free trial. Again, that's going away very soon. You get the reports, the tradable signals. I review every single trade to give you my opinion on it. We back tested our report so we know which signals generate high probability trades, meaning we know which trades are likely to generate a 50+% chance of a positive return. We give you risk control levels. We track the trades and returns. We update it every week. And here's the best part of all. You can trade right alongside me. You want to know what I'm trading before I do so you can get in before me and out before I sell? That's right. I disclose my exact trading book to you. And all you have to do is hit those links in the description below. Sign up for the 30-day free trial because it won't be here much longer. But things that's going to be around is a lot of that debt that just got accumulated because once again, we were right. Again, going back to zero hedge because 3 months later, the Fed admitted, despite its rate cut, the interest rates on credit cards at the end of Q3, 2 weeks after the Fed cut rates, rose more than half a percentage point from the average rate at the end of Q2, a new all-time high. So while banks were cutting deposit rates, they're raising credit card rates. And all that did was bring in a lot of demand for consumers to tap their credit card. And when they get their next bill, they're going to find out there's no relief from the Fed cutting rates. And it's a huge problem because millions of American households are now at risk. They were already struggling with their bills. And now the banks are saying, no, you got to pay even more. And while rising incomes have allowed many consumers to manage the high cost of borrowing, many lower income Americans are experiencing greater financial strain. We know they're falling behind because we know their wages aren't keeping up with inflation. We know their hours worked have gotten cut, and we know that prices have not come down enough, and yet whether they're facing higher payments on their credit cards, you can see how this is going to be devastating for millions of American households at the worst possible time. Fed Chair Jerome Powell alluded that earlier this week, noting that aggregate U.S. economic data look good, but there's pressure in lower income brackets. And keep in mind, that's typically how it goes when you hit into a recession, is the lower income people feel the pain first. They cut their spending because they have no extra spending at this point. Goods prices are still too high. Wages are slowing. Debt costs are going up. And what do they have to do is cut their discretionary spending. That means it impacts other workers who count on the discretionary spend from that cohort. Next thing you know, everything continues to slide down.